What I'm about to share with you in this video, this will make you more profitable. When you understand what the different market cycles look like, you will be able to avoid so many unnecessary losses, and I don't care what strategy you're trading. There is so much value in this very, very short video. We're going to break it down, higher time frame, and never again will you question the different market cycles. In Q1 alone, I've had record amount of people message me that are upset, frustrated because they've been slaughtered by the market. They wasn't able to take the messages. They don't even know what they look like, and then they lose all of their funding. That is demoralizing, and it doesn't always have to be that way. Yes, we have an edge. Yes, drawdown exists, but there are unnecessary phases that a lot of people go through. These awful losing streaks. We've just hit record numbers in our fund because we know what this looks like. And essentially all that means is we know when to be aggressive, scale into the market, and we know when to take a step back. So let's just dig into the charts. I'm going to give you an overview, and never again will you have to guess. So here I have the DXY. I've mentioned this on the channel before about different market cycles and how you can use the DXY to your advantage if you're trading euro dollar or dollar cross pairs. But I want to give you this bigger overview. So right now I'm here on a daily time frame, and you can see I've marked on 2022 to 2023, 2023 to 2024, and then 2024 to essentially present, but I've just mapped out year to year. Now, what do you see straight away? When you just observe this as a whole, when the dollar is rallying to the upside or rallying to the downside, it's very important that you're aware of which phase you're in when you are trading those instruments. Now, it's not just those instruments, it's other asset classes that it affects. So you're going to have a different type of market environment. You have slower periods, faster periods. But if you actually look here, look how interesting this is. 2022, 2023. This little phase here of the move up, the move down, this was the prop bubble, if you like. This is where we saw a lot of people get funded. This is where they made a lot of money. But look at the phase of the market, very directional, as in it's just straight up and then straight down, and then what do? We go into this cycle. Now this is really interesting because a lot of people that were making money or funded or scaled up their capital in here, they were doing really well. So they're making money in this cycle. So if we just section that on, so they're making money in this environment where it's like up, down. It's not perfectly direct, but you can see we are trending to the upside. This one's a little bit more direct, and then we're trading to the downside. Then we go into the sideways market. This is where their equity curve goes from looking like this to then this. It's just a slow bleed like that, slow bleed like that. So they get all of their money here, they lose it here. Now, what do you think happens to the confidence of someone who maybe even scaled up to 7 figures in this section? What do you think they're going to think mentally, psychologically, or even their edge? They wasn't able to look at the different cycles. Now, I'm going to go a bit granular in a second, and this will make even more sense. But if you just look at the bigger picture, that's year to year. So 2023 to 2024 in this cycle, just sideways. Look at that, just sideways. And then what happens when we go into the next year? Pretty much sideways again. Now we get a repeat of some form of direction, but nevertheless it's just the same, just a sideways environment. Now you need to firstly make sure you have a strategy that can trade in any environment. That's rule number one. And then number two, when you go granular, you need to know when to be aggressive or when we're anticipating the next phase. Now with this one, again, chances are this would have been, right, I'm trying to climb the ladder to get more capital, and you find your ways doing it, and as soon as the market goes sideways again, your equity curve starts looking like this again. So this is essentially what we want to avoid. Now, a lot of people in the industry will tell you that that doesn't matter, market cycles don't exist, when they clearly do. They've always existed, and the market is not going to respond the same in a market that's very, very directionally bullish or bearish versus going sideways. That's just the market. The market isn't just going up and down. So as soon as you can look at the bigger picture and go, right, so there clearly are different environments, different phases the market goes through. So surely as a trader, you should be aware of what phase are you in. Now, a lot of the times, you're not going to know what phase you're in until you're about halfway in, or you can anticipate them. Now, to anticipate the phases, well, you need a very unique strategy. We have one that's consistently anticipated phases, and you can go back from Falcon was created here. So Falcon created here. All you have to do is look for our old webinars, and nothing has actually shocked us, because move by move we have anticipated it with a very high accuracy. The only thing that you can't really anticipate is how it's going to get there. You can have a very good idea that price is going to go from point A to B, for example, but you don't know whether it's going to get there like this, or you don't know whether it's going to get there like this. You have got no idea, or in just a straight line. So because you don't know how it's going to get there, that's where you have to adjust into lower time frames and then understand what phase you're in. So now go to present time. What's relevant to you? So rather than going through previous price action, I just wanted to give you the overview as to why maybe you've made money in the past and then you've just lost it, but you've got no idea why, and you've probably questioned your strategy. Well, if you're someone who's trading prop firms, I would at least test this. This is really important. Please test what is your average drawdown that you would experience with your system, and make sure your actual strategy can survive prop firms, because most strategies can't, but they don't realize it, and that's why the prop firm data is what it is. What, 1%, under a 2% chance to be more accurate, that you will make it to a payout. So that already tells me two things. Most people are trading a terrible strategy. They just think it's good because they're cherry picking on the best things, and number two, they probably haven't done the required psychological training to be able to deal with it. And if you think about it, most people lose their capital for emotional reasons as well. So the data is the data. It's not even my opinion at this point. I know it's difficult for some people to swallow, but wouldn't you rather know that now and then not waste another 3-4 years? Like, you're meant to have a great year in 2025. So you have to be aware of these things. So this sideways market, we've been aware of this, and you just look back for old webinars. Even on the channel, I think I've even spoken about this. As the price move up, we're waiting for this to break this high to interact with this area here. This is the top of this bigger range, and then we're looking for more direct movements. So as of move by move, since the start of the year, even documented on this channel, this is going to plan. This is exactly what we want to see. And you know where people get caught out? Because let's look at this. So if we go to the daily time frame, notice how pretty much the bang on the start of March, going from late Feb into March, as we enter into that month, what do we get? 3 consecutive bearish engulfings, sell-offs. Now, when you get 3, and this is a good little gem, when you get 3 daily candles like this, the probability of there then being a pullback, a deeper pullback, is extremely high. Why is that important to you as a trader? Well, let's say you're telling me now, and you can let me know in the comments what your trading style is. You can let me know what instruments you regularly trade. If they are dollar cross, then this is very important to you. Even if they're not, it's going to have some relevance, but even more if you trade dollar cross pairs. So imagine now we take price back and you've not understood the different cycles or where we're positioned in the market, and then you're seeing these 3 daily candles like this, and you don't understand how much we're going to pull back. Well, what we did is this. We marked on this area here, which is 105. The chances are price is eventually going to pull back into that region, which means imagine you're now expecting the dollar to just continue bearish, but you're not anticipating the bigger pullbacks. What are you going to do? You're going to get hammered by false traps on the lower time frames on dollar cross pairs, like euro dollar, pound dollar, and not have any idea of what's going on. So let's play that back. So this little pullback here, this is what's expected. So what you need to learn how to do is study this. You need to know what these different pieces of price action, there's quite a few here, what these different pieces of price action, what they mean and how important they are to you. When you can start to separate them, you will anticipate the end of the pullback phase. Where if you don't know how to anticipate the end of the pullback phase, you will lose so much money in here from moves that they don't really commit. Now, granted, we've had some tariff wars and everything else has caused the market to be a bit of indecisive. The stock market sold off. There's a few other variables. But listen, the last 10, 15, 20 years, there has always been something. But the market has still responded in the same way that it always does. So even though it's new, it's not unique. It's just something else in a different way that's still affecting a bit of indecision. So think about it like this. When the market is uncertain, you see gold rally, which is what we've seen gold keep hitting all-time highs. But when there's uncertainty, you get a lot of indecision in the market. And where are you going to see the most indecision? You're going to see it on something like the DXY. So if you're trading anything dollar related, it will affect you. So what you've got to learn, separation of structures, that's key number 1. How you do that is, of course, most strategies don't even know how to do that. But again, hopefully you have a strategy that can determine all the different phases within them. And then what we will look at is we was actually looking for this move here anyway. I'll give you a bit of a gem. We are actually looking for price to pull up into that 105 area. Now, whether that goes higher or not, that remains to be seen. But as of right now, because we've been studying each section, this is our first section, this is our second section. We actually only need one more section to complete, and this could be the retest of roughly around that area for the next phase. And that's crucial. And the only reason why we've not seen a bigger sell-off on the DXY or dollar-related pairs is purely because of this low to the left. Now, that's a whole other episode as to why that specific part is important related to the left side here. However, pullback is expected. So why am I telling you this now? Well, this is essentially March. Let's look at the exact date, right? So here, so yeah, pretty much here. So we get the start of it, which is a very quick start to March, and then most of March is this, isn't it? Because we're now in April. So most of the month has been a pullback. So imagine you caught some fairly decent trades in this run. I mean, this was like textbook. Price comes into the area of volume, we sell off aggressively, we break these lows. A lot of money made in here. So imagine you then do that. You've now got your capital, and then because you don't understand the different phases, because you don't understand what I just showed you on the daily time frame, so those 3 daily candles, all of your money is now lost. Your funding is now in the bin, right? Your funding is in here, it's in this bin. And that's purely because you didn't know how to deal with this scenario. And I see far too often people giving all of their hard-earned money, all of their hard work just gets undone in a pullback. That's crazy. It gets undone in a pullback, which essentially means, look at this. This essentially means that most people make money like this, they lose it here. They make money again, they lose it here. So they're always losing in the pullback because they're trying to trade the pullback as if it was how they was making money originally. And that is where they go wrong, because there's no higher time frame narrative to even see it ahead of time. It's too zoomed in. I'm telling you this. I've seen it for so many years now. It's never changed. It never does. So I would be very, very mindful that you're not giving a lot of your capital back, when really part of trading, part of your strategy should be, when do I actually need to not trade as much as I normally do, versus just boom, 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 hammering as many trades. Listen, I get it. You want to be in the market a lot, but surely you want to make more. Surely your priority is to make money over just participating in the market. But I've realized it's very, very rare that people even realize that. So I wanted to share with you those phases, because this could save you so many years. If I even think about the different years of Falcon, of here. So imagine you were learning in this phase. That's going to be very different trading the squeeze. I remember this squeeze like it was yesterday. This was a difficult time for most strategies. But you can still make money if your system can mitigate risk in these choppier periods when they're squeezing. But I remember every single phase of Falcon. I remember every single phase of how I've traded. And sometimes there's been trickier times where I can tell you this is a slightly trickier time. This is an easier time. This is a slightly trickier time. And I say slightly trickier. This is straight up easy, really, really easy. And funny enough, our best results have actually come within this section. But that has been over the years. I've refined it. So I actually think the way that we trade now, with the refinements that I've made, in this period when it was a bit harder, we would have done so much better in this phase. And that's what I love about the system, the constant refinement and involvement that we've had over the years. As you can imagine, think about how good the strategy is from here to there. All of that. Look at all the different things that have happened in the market where we've been able to weather that storm, test how robust it is, and of course improve it into certain time frames. And we just launched H4 Mastery recently, which we're starting to see the full effects of that. H4 Mastery since the start of the year has actually been really, really great. Not as many in March, but January, February was phenomenal for H4 Mastery, and we had people hit, their record payouts, the most amount of money. We've had the most amount of people funded. It's been absolutely beautiful. So really know your phases, guys. That's what I want you to take away from this episode. I get asked a lot of questions, and when I see a correlation between people not understanding the phase that they're in and then them losing all their capital and being emotional and thinking their strategy doesn't work or they don't have an edge, you gotta ask yourself that question I asked you earlier. Maybe your strategy doesn't have that much of an edge. You might think it does, but remember, simulation and data doesn't always reflect your ability to trade it. The same way when people say, risk to reward isn't important. I get the theory behind it, but it's not really realistic. Risk to reward is important, because if you have a negative risk to reward and you're now relying on a ridiculously high strike rate, or if you have a, let's say, 1-to-1 risk to reward and you're still relying on a really high strike rate, you're putting the pressure on yourself that you now have to have a ridiculously high strike rate, and it's only a very small percentage of people that can pull that off. What I found the sweet spot to be is the better traders that have a higher chance of succeeding will trade a system that has more of a 60-40, over a 50% win rate. Those tend to be able to do that. And do you know why? Because we're humans, we sometimes make mistakes, we make human errors, but as long as they're controlled and they don't completely derail all of your success, it takes away this pressure to have this like 80-90% win rate. And it's not so wild that you're working with like a 20% win rate where it's like loss, and you're relying on a couple of trades to kind of offset all of the damage. That is really, really difficult, and most people can't hack it emotionally, and they're capped when it comes to the amount of money they can trade with to get away with that. So exceptions don't define the rule. There's no point picking out a few people that you know on Instagram or your favorite influencer that does it, because again, these are exceptions. It's not what most people can find consistency in. And I think what we found is that incredible sweet spot. So however you're trading right now, please take into consideration more of these different market cycles, understand what phase you're in, and it will save you from so much drawdown. Guys, you have to know your data if you really want to become profitable for the long run. And surely you want to be confident to back yourself with all of your funding that you can say, right, I'm trading a system that I know I can trade through any market condition, and I can weather the storm when it's difficult, and I know when to step in when the market gives me permission to do so.